The debate over how banks in the euro area are regulated has never really gone away. But over the past decade it has become particularly intense, shaped by the painful memories of the 2008 financial crisis, the Eurozone sovereign debt crisis that have followed, and the series of regulatory reforms from fundamentally altered how banks are allowed to operate. At the heart of those reforms was the idea that banks should carry much thicker layers of capital than before, so that losses could be absorbed by shareholders and bondholders rather than taxpayers. The Basel III framework adopted globally and the additional rules set by the European Union created a multi-layered capital structure that included minimum requirements, various capital buffers, and loss-absorbing instruments like additional Tier 1 and Tier 2 securities. Over time, this created a highly complex capital stack, a structure so intricate that even professionals working inside banks often complained that it had become opaque and difficult to manage in practice. The overlapping buffers limited banks' ability to actually use their capital in downturns, because tapping one buffer could trigger some supervisory actions, dividend restrictions, or market stigma. This paradox meant that capital intended as a cushion was, in reality, often untouchable in times of stress. Against this backdrop, Germany's Bundesbank, one of the most influential central banks in the euro area, has proposed a major simplification of the framework, seeking to consolidate buffers, clarify the role of each capital instrument, and make the system both more usable and more transparent. The proposal, championed by Bundesbank President Joachim Nagel, is now under discussion within the broader European Central Bank system and could eventually fit into legislative reform at the EU level. The essence of the Bundesbank's idea is relatively straightforward, even if its complete implications are far-reaching. Today, Eurozone banks must comply with several different types of capital buffers: capital conservation buffer, a countercyclical buffer, and buffers for systematically important institutions, and in some cases, a systematic risk buffer imposed by national authorities. Each of these serves a slightly different purpose, but they often overlap, and the way they interact is complicated. The Bundesbank suggests merging some of the buffers into a single realizable buffer that could be used in stress scenarios without immediately triggering penalties or restrictions in practice. This would mean that during an economic downturn, banks could dip into their capital reserve more freely, supporting continued lending and preventing a procyclical and contraction of credit. Alongside this, the proposal seeks to reaffirm the central role of Commons Quality Tier 1 capital, which is the highest quality capital consisting mostly of common shares and retained bearings. Under the framework, would remain the main benchmark for meeting core minimum requirements, but the use of AT1 and Tier 2 capital would be narrowed. These subordinated instruments, which became notorious in March 2023, when holders of Credit Suisse AT1 bonds were wiped out in its forced takeover, would be reversed more strictly for resolution situations, that it is, when a bank is being wound down or recapitalized. The goal here is to remove some of the ambiguity about whether a T1 and Tier 2 can be counted towards ordinary stress buffers, making it clear that they exist primarily for loss absorption when a bank fails rather than as part of the day to caution. For smaller and less complex banks, the Bundesbank proposes a simplified regime. These banks, often local savings banks or regional tenders, have long argued that the burden of complying with the full array of capital requirements is disproportionate given their size and risk profile. The new system would reduce compliance costs for them while still keeping in place a basic level of resilience. In the Bundesbank vision, the result would be a capital framework that is easier to understand, easier to supervise, and more effective in allowing banks to use their buffers when needed. Without undermining stability in normal times, supporters of the plan argue that this could bring Europe closer to a level playing field with the United States, where banks often face fewer overlapping buffers and therefore more flexibility. The benefits of such reform, if implemented carefully, could be significant. One of the main problems with the current framework is that capital intended as shock absorber often ends up acting as a wall, discouraging banks from lending when times are tough. For example, during the COVID-19 pandemic, European regulators no, had to issue special guidance telling banks they could use their buffers, but even then, many institutions hesitated because they feared negative market reactions or supervisory sanctions. By creating a single clearly releasable buffer, the new system could make it easier for banks to keep credit, living in downturns, which is vital for households and business alike. This pro-lending effect is especially important in Europe, where banks play a much bigger role in financing the real economy than in the US, where capital markets are deeper and more diversified. At the same time, reducing regulatory complexity could save banks considerable compliance costs, freeing up resources that could be redirected into innovation, digitalization, or climate transition financing. A simpler and more transparent system might also boost investor confidence since stakeholders would have a clearer picture of a bank's true casual capital position. But the proposal also raises a number of risks and challenges. One concern is that by consolidating buffers, regulators might inadvertently reduce the overall level of capital protection in the system, while the Bundesbank insists that the new framework would be calibrated to keep total capital at prudent levels. Some supervisors and policymakers may worry that simplification could become a backdoor to lowering requirements. Another issue is the overall environment for AT1 and Tier 2 capital. These instruments were designed to absorb losses in ongoing concern scenarios, not just a resolution, and limiting their usability could reduce the flexibility of banks to manage stress before outright failure. The Credit Suisse case, while controversial, showed how complex the interplay of AT1 instruments can be in practice. Removing them from the normal buffer framework might address some confusion, but it could also reduce incentives for investors to buy them, potentially increasing banks' funding costs. Furthermore, markets may interpret any perceiving weakening of capital requirements as a sign that European banks are less safe, which could backfire by raising their cost of equity or debt.